Hey, welcome back to the EForge Podcast, where kingdom entrepreneurs are forged into high-impact leaders and legacy builders. I'm your host, Cory Long, and today we're diving into part two of a conversation that has already shaken up how business owners think about their taxes. If you missed part one, hit pause, go listen to that first. It's on every platform for podcasts. It's on YouTube channel at The Real Cory Long. We broke down the massive, almost 900-page tax bill signed into law under Trump and what it means for entrepreneurs right now. In this episode, we're going to go deeper. I brought back my fractional CFO and trusted tax strategist, Ron Fossum, to walk us through how the top 1% are leveraging this new law, what everyday entrepreneurs are missing and need to know, and how you can build a proactive tax strategy that protects your income, funds your kingdom mission. This is about tax stewardship, business growth, and learning to play offense instead of defense. So let's get into it. All right, Ron, we went through a lot of strategies last time. It was a big old tax code. There's a lot of information in this silly thing. Do you want to go through some of those just to make sure we remind the audience of some of the things that we've already covered?
Yeah, some of them got a lot of press previously. People have probably heard like highlights of them, but there's, like you just said, there's a lot in this bill. 877 pages worth. So last time we went through overtime and tips. Both of those got a lot of press.
Yeah.
The differences between Section 179 and bonus depreciation. Bonus depreciation changed significantly.
I've seen a
Also,
lot of posts about that one on my own feed.
yeah, yeah, for sure. R&D, so research and development, changed dramatically as well to research and experimentation. So the R&D piece is completely redone into R&E as in Edward, R&E. We talked about the Section 199A QBI deduction, which is one of the larger. It's 20% off your business income,
It's huge.
whether or not you were a trade or a business versus an investment, a passive investment or a mere investment is what the IRS calls it. Brand new senior deductions, brand new. This, I think, is his version of a campaign promise. We went over the vehicle interest. That's an odd one. Didn't
Yeah.
I don't see a whole lot of people being able to take advantage of that one. But we spent some time, quite a bit of time, talking about 1202 qualified small businesses and opportunity zones. And opportunity zones have been redone. The increase in 1099s, so we have to send out less
Yeah.
1099s because the threshold from when we send them is up. Doesn't change the fact that we still need to claim all income, but 1099s and then the Trump accounts, which is like a Frankenstein version of a whole bunch of stuff. But the Trump accounts is an interesting play that we can't do yet. Doesn't even start until 27. It's going to be huge for those that have kids. It just brought on a client yesterday. This is Monday. It was Thursday or Friday this last week. 9 kids,
Oh my goodness. That's a
and
lot of kiddos, man.
he had not heard about the Trump accounts yet. So gonna make a
What's
big
crazy, you had mentioned this last time. Most of these haven't, the details are not really there for a lot of this. So this almost 900-page bill already is going to grow even more as they add detail, like the Trump accounts. You said that's going to have more detail to it. And it's going to be fleshed out and go through a couple of other hands before it really gets settled in. This thing
Yeah.
could be 1,000+ pages easily, right?
Oh, for sure.
Yeah.
For sure. By the time it gets through Treasury and then passed over to the IRS. I mean, at the end of the day, the IRS, this was the light bulb moment for me back in the day, was the IRS doesn't make the rules, right? Congress makes them,
Mhm.
president signs off on them. Then they go through Treasury, they define it, and the IRS has to enforce whatever they get from
Right.
those guys. They can't like make up their own rules or whatever. They can argue and we can go to tax court. The light bulb moment was like the policeman can't just randomly say speed limit's 25 because I think it should be 25 and it's posted 35. Can't just
Right.
make can't just make stuff up. So same with the IRS. And so this is going to be an interesting tax year for sure.
Now, this is the crazy part about it to me, as you and I have talked more and more about it. There's definitely some things that are going to have to be fleshed out. And then there's just a lot of new things, kind of like the Trump accounts, things that are just kind of different. You're talking about the vehicle interest thing a minute ago that's kind of just different. Even some of the stuff we're going to cover today, I know some of it's added to or bonused onto, some of it's new, some of it's just bigger or better, just depending on whether you have 9 kids or not. I guess I don't know. That's a lot of kids, man. I can't imagine the food bill in that house, much less
Yeah.
everything else. But yeah, you look at all of the different things that are in this, and we're just going to touch on a few more of these today, even though there's, I'm sure, way more than even what we're going to get to in this podcast. Again, if you guys have not watched the original one, make sure it's on Spotify, Apple, YouTube. We're across all the platforms. Make sure that you listen to that because it has a lot of great information in it. So let's dive into some of the ones that we want to talk about today. I know that there's some about homes or for home builders, that kind of thing that you were talking about. Give us some ideas of some of the newer things that are going to affect for us homeowners or home builders, that kind of thing.
Yeah. Let me give some criteria because this is going to come up on several different strategies, so I don't have to
Mm,
keep repeating myself.
yeah.
But remember that permanent in the tax code doesn't mean forever.
Mm,
Permanent means it doesn't phase out or end, and the very next tax bill could erase some of these things. So when I say permanent, just know that it's permanent while Trump's in office. It's not forever. A lot of this stuff has phase outs. Some of what we talked about last week and some this week both. Phase out is just simply you start making too much money and the benefit gets smaller and smaller and smaller and till it's you lose it all together because you're making too much money. This week, a lot of stuff is going to be indexed for inflation, which
mm,
just is a small little bump every year. And then really everyone wants to spend less. They want the government to spend less, so long as it's not what they are interested in.
yeah.
And so it's borrow and spend versus tax and spend. And this is a lot of, I mean, go figure. He's got a real estate background. So go figure this is a lot of borrow and spend type strategies. And if you're international, if you're doing any international business, man, that could be a whole podcast all into itself because it depends on which country you're doing and
Right.
the tariffs, and that's kind of a moving target there. So I'm going to ignore all the international stuff for sure. As far as the tax brackets, this is the first one. Tax brackets, the same ones that we had last year, indexed for inflation, are now made permanent.
Oh, okay.
So those haven't changed other than what the government considers inflation. The standard deduction changed, same thing. It was adjusted for inflation. And so your standard deduction is 15,750 for a single person, 31,500 for married filing joint. That's already been adjusted for inflation. So if you kind of want to see how much inflation the government's going to add on top of this, makes it easier for us to plan on
Yeah.
a go forward basis when we know that the number is going to change. In the past, it's been, well, what's the brackets going to be? What are the brackets going to be? Then we had to wait for the software, the tax prep software to come out and have all those brackets in there before we could do returns. So
Yeah, while you're on that subject too, for everybody that's listening to the podcast today, you guys are going to want to hang around until we get to the end. We've got some goodies for you that we're going to get to you. And one of those is going to be exactly what he was just talking about, which is this idea of tax planning versus tax prep versus these other roles that could be on the tax team. And so we've got some goodies for you. Make sure and hang out till the end of the podcast. We want to make sure and give those to you for free today for listening. Ron's been kind enough to pass those on. So yeah, so and we talked about in the first podcast, like there's big differences in those things. And you're a tax planner. That's very different than a tax preparer. Two totally different jobs. So as you're getting into today, these are remember that for all you listening, like this, the idea is for us to look ahead and go, okay, here's what we're thinking our business is going to do this year, and this is what we think we'll run, and this is how much income we think we'll have, and and strategies can start to be created before as the year starts to go, instead of what I started out doing in business initially was I'd wait till the very end of the year and go, okay, what do we do now? It's not a great strategy.
Yeah.
Not a great strategy.
Yeah. So for example, we would take the first 6 months and say, hey, duplicate that for or anywhere throughout the year, prorate that income, and then go, great, they're on pace for this much income, this much passive income, this much ordinary income, and oh, by the way, they've got a business for sale or a property for sale, and there's going to be capital gain. And now we can plan around all of that
Which will be it.
versus,
Like even for me this year, we're selling two businesses. That's something you and I have already chatted about. We know there's going to be some income coming in from that. Those are things that we can plan for.
so you asked about home interest, and so they made this $750,000 limit. The most you're able to deduct on your primary is 750,000 of interest. See, it's probably one of the most common mistakes I see in returns is people are writing off their whole payment,
Oh,
principal, and it's got to be interest only. So not an interest only loan, but you can only write off the interest of the principal and interest. You have to bought your house after December 15th, 2017. It was made permanent. So right up until the next guy comes along.
yeah.
And this is brand new, is mortgage insurance premiums are now deductible the same as interest.
Oh,
And that starts next year in 26. But if you put less than 20% down, you've got some mortgage insurance. And we're going to be able to write that off the same as interest
that shows up
on it.
as PMI, right?
Yeah,
Yeah.
yeah. So that one's totally new and can't quite do it yet, but 26 will make a big difference.
Yeah. You were
Uh,
saying even a lot of the tax laws from last time were next year or the year after next. So we just need to be planning and preparing for those as they come in.
yeah, the Trump account one I didn't understand. They pushed that one out to 27. There's some things that we can do for going backwards. Usually we can get 3 years if we're going to refile a return. 3 years going backwards. There's some this year, some next year, and then like I said, 27. There's still another one.
Which we did on the last podcast, guys. If you haven't listened to it, Ron made a special offer. If you wanted him to go through and look at your taxes and give you some ideas, he made a special offer on that. So make sure and go back and listen to that so that you can see if you can take advantage of that. It's a good time to do that right now. We're sitting in August. This is a great time to make sure that you have a good tax plan in place for 2025 as we finish out the year, especially if you're looking at selling businesses or houses or any kind of thing. It's just your income, and whether you're W-2 and a business or just a business, or there's all kinds of
Yeah.
things that I've learned about the way all of this works that I had no idea when we started this stuff 10 years ago.
We tried to simplify it and just do a red light, yellow light, green light type idea. Green lights are some opportunities that were just missed that we can do there for this next year. The yellow lights are, hey, let's make sure we document this properly. Red lights are like, this is just wrong. Like P&L or the W-2 doesn't match what's on the return or something like that, that sooner or later will trigger an audit and probably should be fixed type idea. But just in this one, just in this home interest deduction, I gave two different dates, right? Someone who bought their house after 2017, but now we have mortgage insurance for someone who's just buying a house this next year.
Right. That's confusing.
And so getting a custom tax plan is just more important than ever because we had Trump's first one and we had Biden's. He made some changes, not nearly as much, and then we had COVID that changed a whole bunch of rules that were all short-term stuff. And then now here we are on, Trump 2.0. It's just more important than ever that we keep track of this stuff
Right.
and get a custom tax plan. The kind of spinning off of that home interest is builders kind of got slammed a little bit on this one. Now they're having to pay taxes based on a percentage of completion. So think about that. If you're 25% done, you got to pay tax on the value of the house at 25%. And mind you, you've got money going out for the construction, and you're going
Right.
to have that going out for the next year or 2 years. Can't go beyond 3. It's got to be 3 years or less. But that percentage of completion method of accounting is really problematic for builders. And it applies to all residential, so apartment buildings, multifamily units, assisted living facilities.
Oh,
Uh,
interesting. Yeah, that's going to make for some very interesting taxes. Like you said, there's going to some people need to talk to somebody. Somebody's gonna
and there,
somebody's gonna need to
yeah,
be involved in that conversation.
there's a nuance there with a home construction contract that has its own set of rules, and you overlay all of this over alternative minimum tax. And so alternative minimum tax is like a whole separate, it's like the frontage road. The rest
Mm.
of us are all going on the freeway, but the frontage road's over here. Alternative minimum tax is kind of a parallel tax bracket, but this percentage of completion method in the home construction contract piece adjusts your AMT to conform. So now you've got almost a, a second frontage road.
Yeah, that's gonna make for some interesting taxes. Yeah, I'm glad that I have a lot of friends that are CPAs and accountants and tax preparers, but glad that was not something that I ended up doing. That would not be fun. There's going to be
Yeah,
some interesting taxes come out of all of this, and what people are going to have to do to make sure that they've paid what they're supposed to pay, when they're supposed to pay it, how they're supposed to pay it. It's definitely going to be
I get
interesting.
I get questions daily from accountants, bookkeepers, CPAs, the tax preparers that are like, "Hey, how does this show on the return, or what documentation should I be collecting?" And it's getting more and more complex. We
Yeah.
thought tax was busy before. Oh my goodness. They even spun off, so kind of still along the lines of the home, the build. Now we have a farm sale. It's a brand new section of the code. And so there's rules that if you've operated the farm, you're a qualified farmer, which means you're actively engaged, and you've done that for 10 years or more, and you're not a passive investor in a farm, then you can make the sale July 5th, 2025 or later. If you've made the sale after July 5th, 25, you can make 4 installment payments on the taxes. And what they're trying to do is, I'm guessing, I was not invited to Congress, but
Yeah.
it looks like they're trying to incentivize farms to stay farms.
Mm. Which there's a big lack, right? From what I've read and understand in the US right now, the amount of
Yep,
farms and what's needed compared to the population, like there's a massive issue there.
yep.
And it's shrinking, the farmland shrinking. So I don't know. That's interesting.
And
Makes sense they'd want to do that.
yeah, it, it's an unextended deadline. So
Mm,
depending on what type of entity, if you're a C corp, you probably have a different tax filing deadline than you're just operating as a sole prop or LLC as a sole prop. And so extensions don't count. Your first payment has to be done by then, and then the 3 subsequent payments have to be done on the same date for the next 3 years.
oh wow.
So I can picture a farmer going, sold my farm, I'm done, I'm retiring, I'm going to go put the money in the stock market, and maybe he doesn't choose great investments, or his financial planner
Yeah.
doesn't choose great investments, and he loses some money, but he's still got to make that payment for the next 3 years.
Yeah, and I imagine that could be pretty weighty. Farmland's not cheap.
That's how it could go sideways for sure. His base is certainly Midwest for sure.
Yeah. That's
Yeah. So
interesting.
just there's the home, the builders and farms. Heaven forbid you actually have multiples of those. Like you live on your farm, and then recapture can kind of come into place if you've ran the home office or something over and over again.
Yeah, that could make it
Another
really interesting.
another one is like no one ever liked the kid on the school ground that like changed the rules of the game as you played. And this is what this one feels like. We had the ERTC, which is the part of the COVID credits and refunds, but they changed the statute of limitations and a retroactive due diligence requirement for anyone that promoted that.
Okay.
And so there was just so much abuse.
Yeah.
They're clamping down, going, we can't audit as many people as we want to audit, is what that tells me. Totally willing to be wrong. Too many people went out and bought Ferraris and
Yeah.
didn't didn't use the money for what it was intended. This seems to be more after the people that sold it more than the actual taxpayer, is what it
Okay.
looks like. But taxpayers is still mentioned in here, and if they file an improper claim, there's some penalties for them as well. Not sure why they did this next one. There's fires, floods, hurricanes, earthquakes, like all these natural disasters are increasing at a ridiculous rate.
Yeah, it's nuts.
So Section 139 was on the tax code books ever since Reagan, Jimmy Carter to Reagan. So like immediately the first month of Reagan being president, Section 139 came on the books. And that came from a bunch of hostages in Iran. I think it was, I don't even remember how many hostages, 20, 30 some odd hostages. And while you're hostage in Iran and they didn't file their taxes timely, they had pretty stiff penalties. And so
Yeah,
they
that
came out
makes
with
no
Section
sense.
1. It took 5 years to get this resolved. Tells you how much work they used to put into the detail back then
Wow. Yeah.
versus now. But 5 years later, they came out with Section 139. It says, hey, if you're a state or federal disaster, declared disaster zone, which we see in California a lot with the fires, right? But they all count. All the natural disasters count. If you're a state and federal, then that counts as what they call a casualty loss. That is 100% deductible year one right up front, but there's no personal casualties any longer. So those have all been disallowed, but it seems like they're just reinforcing Section 139 that says, hey, you got to meet the federal and state guidelines.
Interesting. Yeah, that seems like a weird one to have in this. I don't know.
Yeah, the next one is excess business losses. There's limits on how much of a loss you can take based on the amount of income. So the phase out that I mentioned earlier, it's going to be 313,000 for a single person, 626,000 for married filing joint. But if you go over that amount, so let's say you've earned this much money, you've lost this much money, one should wipe out the other. That's fine. But if you go into excess losses and you exceed those limits, now you have to carry those net operating losses until you have to carry them forward until
Oh.
you do have some profit. And so that tends to come up with like a real estate professional is probably
Mm,
the most common one. They go out and they do some cost seg studies or something. They only made $100,000 in rent revenue, but they're trying to write off $1 million commercial property or something.
right.
That's going to be excess.
So that would just carry through to the next year or until they get enough profit to cover that excess.
Yep. So for example, if someone has $1 million salary, they're married filing joint, they have $50,000 of business income, $1 million and $1 million business loss. They can only write off the 50
Interesting.
as excess business loss. Then they can write off 626,000 against the W-2 income. And I don't know if these numbers are going to come through in a podcast, but it's all the more reason you need a chart, a graph, and plug your numbers in. But the remaining excess of the 324 would then have to get carried over to the next year. So excess business loss, it's also any kind of depreciation, business loss against salary income or business income. You got to make sure that we do that math correctly so that you don't think you're getting to zero, but you've exceeded the loss limit.
Hmm. Interesting. Yeah, that's totally different. That's very different.
Yeah, excess business loss for sure.
Hmm.
Uh, worth talking to your tax preparer about. It's probably too late if the preparer has already got it. It has to be done prior to end of the year. Where we had state and local taxes was raised so it's called SALT. If you guys ever see the abbreviation SALT, it's state and local taxes. Any place, so California, New York, and Hawaii were the worst ones because they have the highest property taxes and the highest property prices. So then consequently, they're going to have the higher state tax as well. So they've gone from $10,000. They raised it all the way up to $40,000 as the new cap, unless you make too much money, and it phases out, and it phases out and drops back down to 10. So it's almost like that. You remember the bell curve in school where
Yeah.
it ramped up and came back down? So we started out at 10, we went to 40, but we can go back to 10 a couple of different ways. And again, I'm not sure how much of this is going to come through in a podcast, but if you're modified adjusted gross income of 580, you paid $40,000 in state taxes, but you're $80,000 over the $500,000 limit, then you can only take 30% of the 80 that you're over, just 24 grand. Right? 30% of 80,000 is 24 grand, which means you have a $16,000 state and local tax deduction. 40,000 minus the 24,000 equals the 16. It's
going to get complicated.
Yeah. If people didn't like taxes before, they're not gonna love this one because there's so many moving targets. But there was a workaround in almost every state when they passed this previously. And if your tax team didn't show you a way to do the workaround, probably time for you to upgrade your team. And so if you had a pass-through entity, which is everything except a C Corp, there's a workaround for that. There was only, I want to say 5 states that didn't have a workaround for the income taxes on the pass-through entities. But just because they have it doesn't mean it's great. Like California's is pretty weak compared to other states.
Yeah.
And if you're in those states, if you're in New York, California, Hawaii, this is like multiplied times 4 over the rest of America. The taxes are expensive in those states. State taxes, besides the taxes and the price and the interest. The interest is going to hit that threshold that we talked about earlier. But yeah, that pass-through entity structure still should work.
Yeah, that's crazy. Like you said, some of the states are much worse than others. We've been fortunate. We've lived in mostly states that don't have state taxes, so we haven't had to worry about state income tax, some of that kind of stuff. So, yeah.
Yep. Yeah. What is there? 7 states that don't have state taxes. I told my wife, you can pick like for
any
our retirement.
Of the 7.
Yeah. This is where we're going. We're either staying here.
Well, it gives you an immediate raise. You get a raise immediately for doing that. For you and I, we're not restricted to a particular location to do our job. I could live anywhere. It doesn't have to be any particular place.
And state taxes seem to come back every 2 to 4 years. So it came back again. This time they're made permanent. Right.
Whatever that means.
Right up till they're not.
Right.
They're very slightly indexed for inflation, but they raised it to 15 million per person or 30 million per couple. So my first 30 million between my wife and I is completely exempt, not just estate tax, but also gift tax. Probably in this category, the number one mistake I see is people thinking, oh, I've got a trust, and so that doesn't apply to me. Most people, I'm like, great, send me a copy of your trust. We'll have our attorneys look at it. And by the way, I do the tax planning, but we've got bookkeepers, we've got accountants, we've got tax preparers, we've got tax attorneys. Like, we've got a whole team. I just spend my time on the planning piece,
right?
For sure. But that's my most common question. Hey, I've outgrown my team, but can you do tax prep? And I'm like, well, it's not me, but
right. I have a guy though.
my team absolutely will understand what we're trying to do in your tax. But the mistake I see on the consumer side is thinking that they have a trust, and so that doesn't apply to them. But a living trust is what they end up having, which is fantastic tool for probate. It does absolutely zero for taxes.
Mm, good to know.
It does absolutely zero for taxes. So normally you're going to want a living trust. A will inside of your living trust is what I've always heard. I'm not the attorney. The attorneys have always told me as soon as you have a kid, a house, a business, or a net worth over $1 million, those are all your triggers for, hey, let's get a will and a trust done. And they're pretty inexpensive, anywhere from $800. We can do them online, where our attorneys have kind of built out a structure and then send you the documents afterwards. Or if you want to meet with an attorney to actually ask questions and stuff, they usually run anywhere from $1,500, $2,500 to do a living trust. If you've got any one of those criteria, like I would say, run, don't walk, don't pass go, get one of those done.
Yeah, it seems like some of those simple things like that, because I know when you and I met, we started talking. We'd done ministry work forever. I not only did I have no net worth, but I probably had a pretty negative net worth at that point. Like there wasn't any value. After we started the businesses, started kind of moving along, you and I kind of talked about, okay, here's some things we start to put into place to make sure that we have everything in place just in case something happens. I mean, even when my dad passed, he had a will, but not a living trust, which meant that we had to go through the whole probate thing. And it was a 2-year process of going through all that. Luckily, me and my brothers, we were great. Like everybody was great on our end, family wise. We didn't have any issues or anything, but it still was a very long process. We had a house and dad had some other stuff that he owned, and it was interesting to go through all of that and see kind of how all that works. But yeah, I would rather have it all set up, have it set up right, make it really easy as best we can for whoever's got to take care of that.
We throw in an ancillary document called a survivor's guide. It's not a legal document. Your will and trust are legal documents, and that's where all the assets are listed. That's where all the decisions are made. But what I frequently see is it's not the kids. Like you said you and your brothers all got along.
Right.
It's usually not the family. Occasionally it is, but it's the significant other.
Oh yeah.
So I'm just going to pick on your brother for a second. It's your brother's girlfriend or your brother's spouse or aunt, or like there's someone talking in this year,
Right.
and they go and repeat it to the family, and then they stir the pot and that kind of stuff. And so the survivor's guide kind of walks through all of the decisions that aren't really legal decisions, like what kind of service do you want? Do you want a graveside? Do you want open casket, closed casket? Do you want cremated, or do you want direct cremation? Most people don't know there's 2 types of cremation. Oh, like what do you want to have? Do you want flowers? If so, what happens to flowers afterwards? So we put down, yeah, I don't mind some flowers, and they're going to go to the local long-term care facility when we're done with them and the service is over. All of the things we don't really think about.
And there's a
Week
lot.
one, yeah, week 1, we do this. Week 2, you should be doing this. Week 3, we should be doing this. And that way, your dad would have had all of his wishes on paper, and it just gives ammo to the person to go back to the significant other and go, no, this is what dad wanted.
Right.
It also takes a lot of the pressure off of the executor.
Yeah, I felt bad for my brother. He was the one that had to do all that. And there was a lot of moving pieces. Dad had a business. Dad had multiple homes at one point in time. He had land. He had this, that. Like, it's just a lot of moving pieces that he had to figure out. And he wasn't prepared well for all of that. Even though we tried, like the brothers tried the best we could, he still wasn't prepared very well for all that. And you don't think about it until you're in the middle of it, and then you're emotional and everything's at a
Yeah.
high and everybody's trying to figure out what just happened. And yeah, it's, man, I learned some valuable lessons through all of that for sure.
Well, the good thing is you've gone through that whole process. And so now your kid doesn't have to go through that.
Right. Yeah, we've set up the stuff to make it way simpler for Lexa when we pass. Like,
Yeah.
should be way simpler process. Way simpler
Yeah.
process for sure. That's definitely something though that I'm glad that we communicated about it. that got attorneys involved, that we have things set up and in place now, because we got a living trust set up years ago when we talked about that with the will, made sure everything was set up and done correctly. We've got their survivor's guide and we have all of that in place. But there's all those little goofy details that you don't think about. And again, you're not really in a state to think about it after the fact. It's just a lot. It's just a lot it's a big burden to carry. It's a very big burden to carry.
Well, the last thing, everyone has heard this, but the last thing we should be doing is making large financial decisions immediately after a loss
Right.
in the family. Like we've all heard that advice, and yet we don't put the tools in place to do it. Like shame on us. And so I kind of view it as shame on us for not helping people plan. At the end of the day, we're a planning office through and through. We're not really on call
Right, right,
because
right. Yeah, yeah, yeah.
planning doesn't really happen by accident. That's just one more thing that we can bring to the table to coordinate. Hey, here's your tax plan. Most people start taking the savings from that, and then they want to go invest, or they're going to fund their retirement account, or they're going to go do all kinds of stuff, hire the person they didn't think they could hire in the business, whatever it is, and then let's look at your estate and where that's going.
Makes total sense. It's why it's good to have professionals around you. People that have already been there, done that. They know what they're doing. Just makes things so much easier.
And it helps when they all communicate and talk to each
Yeah,
other,
yeah.
and they're all on the same page. Last thing, one of the things I hear a lot is, I said, when does your financial planner ever call you with the tax person on the same call? And,
Mm,
oh, that's never happened. Well, when has your attorney called and been on the same call as your financial planner or your tax planner?
never happens.
Yeah.
Yeah.
So we kind of view it as our role to be your personal CFO, your fractional CFO, to kind of bring you're still the CEO. Cory's going to manage his whole asset base, net worth, but who needs to come in and communicate and have two or three people? And I get it's difficult to coordinate everyone's calendars nowadays, but thank goodness we got Zoom. It doesn't have to be, a 2 hour meeting. I
Right.
mean, it could be a 15-minute meeting. The attorney drops off and we go do some other stuff. Or so we went down a rabbit trail.
Yeah. That's okay. I know you only have a few more left. Some
Yeah,
about depreciation.
almost all of us think that depreciation is good, but sometimes slower depreciation is better. And so if we only make, let's just say we make $50,000 in the business, but we heard about this section 179 where I can go right off a heavy vehicle, and I'm going to squeeze that all into year one. I'm going to do a cost seg on my property and I'm going to squeeze that in. I bought all this office equipment and I'm going to depreciate all that out. And like all of a sudden, the depreciation takes us in excess of our basis. Basis is just an accounting term that just says, I bought the stock for 50, I sold it for 100. My basis is the first 50. For a house, like every asset will have basis. And if we exceed that basis in our company, thinking that we're writing stuff off, it can trigger additional taxes.
Mm,
And so sometimes taking slower depreciation makes more sense. If we've only done, I'm just going to make up numbers, but if we've only done $50,000 in revenue, maybe it makes sense to take the car over the next 5 years
right.
and just write off the business expenses, the desk and the computers and that stuff, cell phones and what have you. Until you do the math, you're not going to know if you're going to exceed that basis number. December 31st is way too late to
Yeah.
figuring that one out.
Yeah. Yeah. I think that's something that I didn't realize until we started working with you was, we start talking in January and we start creating a plan and moving through the process. All of the previous CPAs, the accounting firms, the people that we had worked with, we might meet once a quarter. Very rarely did we talk about tax strategy. It was usually about books and, all of the kind of fun stuff. And then we get close to the end of the year and it was like, we've got all of this taxes that we're going to owe. Like, what do we do? What do we do? And
Yeah.
that's not a great plan. It's not a great plan to have.
Most accountants and CPAs will do a tax projection, and don't confuse that with planning. Projection is just saying, hey, you're going to earn this much money quarterly or monthly, send in this much money to then pay that tax.
Right.
It's not reducing, eliminating, deferring the tax at all.
Right.
It's just trying to help you set yourself up on payments.
Yeah. That is a totally different thing than tax planning.
Yeah.
And we learned that pretty quickly. So talk to us about the charitable giving. Sounds like that's changed too.
It has. Frequently in the past, we would want to do the charity work out of the business. Now, with your QBI deduction becoming so important, when you do it out of the business, the charitable tax giving, so whether it's regular charitable or leveraged charitable, for those that don't know, charitable is just I earn $1, I give $1, I'm zeroed out in taxes. Leveraged charitable says I earn $1 and I'm going to give it to this charity, but they're going to be able to leverage it and get me $4 or $5.
Oh,
So that's leverage charitable. So the last thing we want to do is start reducing that QBI, qualified business income, on the business side, because that's 20% of your business income. More often than not, going forward, we're going to want to be doing all of our charitable. We can still do the charitable and the leverage charitable, but let's do it on the personal side rather than the business side so that we don't reduce that QBI and we get the largest deduction. We can use that for other stuff.
so they raise that amount?
No, it's still 20%.
Okay.
Yeah, that was QBI came out of Trump tax plan one, but how it gets accounted for on the return, for sure. We want to do it on the personal side now. Most of the like solar and wind and like all the green alternative type stuff, all of that has, and residential solar is all going to have to be wrapped up by December 31st. Commercial solar is an exception to the rule. Again, we're waiting on some definitions for this one, but commercial solar is good for at least for the next 5 years. It has a date. It's not permanent. It has a date. But the part that we're waiting to figure out, I'm waiting on the tax attorney to tell me and give me an opinion letter, if that will go backwards or not. Can I go buy some commercial solar credits and then refile the last 3 years returns and get the money that I've already paid back or not? We definitely have a commercial solar going forward. Most people started reading about solar and just blow out the rest of it and well, solar's gone. Commercial solar is still around, will be around for the next 5 years as a credit. If you remember, a credit's dollar for dollar, a deduction is worth whatever tax bracket you're in. So if I earn $1, I get a $1 tax deduction. I'm in a 30% bracket. I've saved 30 cents. So that's usually what accountants are like. Oh, go put money in your retirement account and then go spend the money.
Right.
Well, spending 30 cents to not have 70 cents is silly.
Yeah, it doesn't make much sense, does it?
It's a really hard way to build a net worth.
Yeah.
Spending $1 to not give the IRS 30 cents. So those are commercial solar credits. And then the child tax credit, that went from $2,000 per kid to $2,500 per kid. But they did specifically put a rule on there that said the Social Security had to be on the return in order for the credit to be refundable. So it's not going to be refundable. It would just carry forward unless we use the kid's Social Security on the return.
So the guy that has 9 kids, that's a lot of extra money. That's extra
Yeah.
$500 per kiddo.
Yeah, he's got the record. I've got another client in New York, sweet family, just a sweet family, and she doesn't drive. Like her job is to take care of 7 kids, and I taught him how to employ the kids. I think out of the 7 kids, I think 4 or 5 of them qualified to work in the business, and we did like 2 other strategies. And those 3 strategies was, Ron, I'm already down to 0. Like, well, we're done.
That's amazing. Yeah. Yeah. We only had 1 kid, so we didn't, I don't know.
Yeah,
Yeah, was what it was.
spoiled it rotten.
Yeah, that is very true. Way too much. That is very true.
Yeah.
Man, we covered a lot of ground, whether you are whether you're a residential homeowner, whether you're building houses, selling farms, whether we're talking about ERTC or casualty losses, business losses, salt, state taxes, depreciation, charitable giving, solar, and now child tax credits. And we still probably aren't covering, between this and the last one, we're probably just still covering just a little piece of this almost 900 page bill. It's crazy to me how much is in this. And I'm sure that you guys will be working through this for a while. All of the tax preparers and tax planners and the tax attorney, anybody that has to do with taxes are going to be busy for a while trying to figure out exactly how we utilize this and what are the rules, what's going to happen next, how are these things going to work. Anything you want to leave everybody with, just out of curiosity on what you've kind of shared today with the tax stuff? Is there anything that you'd be like, here's a golden nugget to take with you today?
The Probably the biggest thing is and it's in here is 12 questions to ask your tax team as one of the freebies. So I've given you the question and the answer. And if they can't answer some of these, this is like rookie 101 stuff. But most bookkeepers, accounts, and CPAs want to put numbers in boxes.
Oh yeah.
Taxes are as complex as ever. Like if you're a W-2 person, you might be able to get away with TurboTax, but you're definitely not anywhere close to writing anything off because there's nothing in TurboTax for writing down that income on
Right.
W-2. And I think we've got like 30 some odd, 30 or 31 strategies for W-2 income. It's more important than ever to look at who's on your tax team, what is it they're doing, what's their education level. Not uncommon to outgrow any of the professionals.
Mm,
I don't use the first attorney I ever had. I don't even use the second attorney I ever had.
right.
I agree with you guys. And it's the same with bookkeepers, accountants, and preparers. You can outgrow those people. And if you want to pay less tax, it's infinitely easier to save money than to go earn more money.
Right.
What is it? I just spend a few minutes talking to your spouse, and or if you're married, and saying, what if we could reduce our taxes by 50% or more? What would we do?
Right.
Is it a family vacation that hasn't happened forever, or is it funding your retirement, or what's your goal? And spend some time thinking about that and just go on, okay, if you've got the bullseye and you know the outcome, now you can, like, the answers will start to show up. Taxes are it's almost always our biggest bill.
Well, when you and I had the very first conversation, that first year that we had paid 92 or 93,000, whatever it was in taxes, and you were like, you paid what? You were like, what are you doing? And then we had the conversation about how do we fix this? Like, what do we do moving forward? It opened my eyes because my dad had owned a business for all of my childhood. Like he had owned a business for all of my childhood, but he'd always used just a local CPA service. They were great, super kind people, great people, not tax planners, not tax attorneys. They were CPAs. They put numbers in boxes and they knew what they knew and that's what they knew and that's what they did and it was great and dad was fine with that. But boy, it opened my eyes to what all could be done and how the tax laws are created and what they're created for. And I know it helped me tremendously. We had talked about earlier some freebies. You just mentioned one of them, which is the 12 questions for a tax team. We also talked about who is the tax team, like who all. So those are two freebies you want to give away, and then also 5 criterias for tax deduction, so that you know what those criterias are for what can be put on that deduction. Those are all something that you're willing to give away to whoever's listening to this podcast that would like those today. Go to Tax Plan Wealth. Make sure that that is taxplanwealth.com is Ron's website. Check out the site, email them, ask them. They will pass that on to you. His executive assistant will get that to you. But it's the who is the tax team, the 12 questions for the tax team, and the 5 criteria for tax deduction. Guys, these are all freebies that he wants to pass on to you. These are things that you should be digging into. And just like he just said, we went from that $90,000 tax bill to over the years, we've been able to take oil credits and do other things through the years as we've made investments or taken the Augusta rule or one of the other things that we've been able to do as either tax credits or tax savings. And even in our website business, we have tax credits that are available for people. It fascinates me, all the different rules and all that's in there that people don't even realize are in there because nobody says it. I think one of the things you and I did at an event one year, you said, "Hey, I'm going to come." I think this was for our VIP people. I can't remember. But you said, "Hey, tell them all that I will give them enough tax strategies to pay for this event like 3 times or 10 times over or something." I don't remember what it was, but it just fascinated me because the people that came there, they literally walked away with more money in their pocket, even though they invested to come. They walked away with more money in their pocket because of the tax tips and the tax savings that happened from that, which is pretty amazing. Ron and I both should be at a event coming up this year. It's going to be November 7th through the 9th. If you're listening to this podcast today, definitely check it out. It's called Magnify Your Wealth. You'll be able to find that on any of my properties that are out there. We have some bonuses if you buy through my link and register for that event. But that is one of those events that can help you with tax savings. It can help you with entity structure. And you will get into a room with people that are playing at a different level. And you'll learn about things that, just like me, I've learned about every single one I've gone to. I've learned about something that I didn't understand, business credit or other types of investments or how to use a self-directed IRA. I'm going to be teaching on AI search there. It's going to be a lot of fun, but definitely follow me at the real Cory Long, and you'll be able to find that on any of my social media that's out there. This is a wrap up of from part 1 to part 2. We covered a lot more material tonight with our series with Ron. If this episode helped you think differently about taxes or wealth, stewardship, just don't keep it to yourself. Subscribe, leave a review, share it with business owners, other entrepreneurs, W-2 earners that might be overpaying. They need to start planning now. You can connect with Ron at taxplanwealth.com. Make sure and check out all of his website. He's got all kinds of goodies on there. Like I say, you'll be able to get your free PDFs and those downloads. Just hit their team up through their email. We'll be back next Thursday right here at the Forge, where leaders are made and legacies are built.